Today, we're breaking down IAS 16. That's Property, Plant, and Equipment. We'll cover what PPE is, examples you should know, how it's measured, the two model types, depreciation, presentation, and disclosure. The full package. In short, we're unpacking everything PPE. Let's dive right in. Property, plant, and equipment are tangible items that A. Are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and B. Are expected to be used during more than one period. A type of PPE is a car or van. For instance, a delivery company buys a van for £20,000. It uses the van to deliver packages to customers. That's part of supplying services. The van will be used for several years, not just one. Because it's tangible, used in the business, and expected to last more than one period, the van qualifies as PPE under IAS 16. Other common examples of property, plant, and equipment, PPE, include land and buildings used for operations, office furniture like desks, chairs, and cabinets, electronics such as printers, calculators, and company phones, shelves, generators, or industrial plants for operations, and tools for the company are also examples of these assets. These are all tangible assets that help a business run and are used for more than one accounting period. When it comes to recording PPE, the cost must be clear and reliable, and it should help the business in the long run. You can record it using either the cost model, where you subtract depreciation over time, or the revaluation model, where you update the asset to match its current value. And remember, we don't deduct the full cost immediately. We spread it using depreciation, either straight line or reducing balance. That way, your accounts stay realistic and accurate. When presenting PPE in your financial statements, it shows up under non-current assets on the balance sheet. That's your statement of financial position. But it doesn't stop there. You also need to disclose a few key details, like the depreciation method you're using, how long the asset is expected to last, and whether it's been revalued. Oh, and if it's been impaired or lost value over time, that needs to be shown too. The losses and depreciation go to your statement of profit or loss as an expense. This further reduces the carrying amount of the assets in the statement of financial position. When you get rid of an asset, maybe you sell it, scrap it, or just stop using it, you've got to take it off your records. But here's where it gets interesting. You may have made a gain or a loss. Let's say your company sells a piece of machinery for £2,000, but in your books, that machine was only worth £1,300. That's a £700 gain. Nice. Now, flip the scenario. If you sold it for just £1,000 and it was still worth £1,300 on paper, that's a £300 loss. Either way, the difference goes into your income statement. IAS 16 in a nutshell: track and value long-term physical assets. Don't expense, depreciate over time. Show it on your balance sheet, plus key disclosures. Sold or scrapped, report the gain or loss. That's IAS 16 Simplified. Because accounting should make sense for everyone, follow at the base solution for more bite-sized finance tips.